Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm going to talk about market correction. And the reason I want to talk about this with you is because I'm having a crazy time in this market. Like the clients are just dropping from everywhere, and people are just in a frenzy to buy right now, almost before Christmas. They just want to buy before, as if everything's going to fall off the cliff, right? And this is where I need to talk to you about market correction and why it's so important that you need to watch all of this video, right? And if you are looking for someone who can truly help you and be in your corner, you need to become part of our clients, because if you're not, you really should be rethinking your strategy. Because if you've got the wrong strategy right now, or if you're just out there like everyone else buying crazily in the market, the yields are going down, prices are going up. That's what happens when we're in an inflated market. And so many people are overpaying. I'm watching people outbid us at deals. I'm watching people go into silent auctions. I'm watching people in multi-offer situations. It's just, you've got to protect yourself. It's just going to fall down at some point, right? And you have to look at what happens in market correction, right? It means that, how do you insulate yourself? This is what I'm talking about today. How do you insulate yourself against market corrections? What's going to happen if the market corrects itself? And I want you to know how and where you should be buying right now so that you can actually secure the best deals. So, firstly, we have to define. Here's what we define: yield. So we've got to define the yield. And why is that so important? Is you've got to define what is the right yield, right? So if the right yield is at 6% right now in the Brisbane market, you might be able to go either side, right? So you've got 6.25, 5.75. That's fine. But if you go to 5.5%, you are paying above market for that deal, right? Unless you've got a medical tenant, 10-year lease, development potential, all of the things that are upsides. 5.5 with something that doesn't have that long lease, doesn't have that security, you're paying over the market, right? And it's that across the board, right? If you go regional, there's towns that are 9% towns, traditionally 9%. Now you might be paying 8% for that town. That's fine, but a lot of people paying 7 or 7.5%. You're overpaying for that deal. Go to rural areas, you should be getting 14%. People paying 10%, you're overpaying. That's what's happened. Come to Sydney, Melbourne, you're paying 2% for something that's maybe 3% or 3.5%. You're overpaying. That's what happened. You have to define market yield. Really, really important. And the only way to do it is to be with someone, part of a community, or align yourself with someone who understands what's going on in this market day in, day out, and knows exactly what's happening. Or otherwise, you sit on the internet and you troll through all of the listing, talk to agents, make about 50 phone calls a week. You do that for 2 weeks, you'll find market yield. Find the area you want and start calling. That's the only other way to find it. But the other thing is what happens in a crash. And most people don't tell you this. What happens in a crash is the reverse of this happens. So yield goes up and prices come down. So what we have is, say for example, you pay 6% now, let's say in Brisbane, right? And right now, if you pay 6%, that's the market yield. But if the market corrects itself, what happens is that 6% property, now that yield starts to go up. It goes up to 7%. What that means is that prices start to come down. So your $500,000 property or $600,000 property is no longer worth that. It's now worth $570 or $560. That's what it's worth. Now, you are still going to get positive cash flow, so you can still hold the property, but the thing is now the value of the property has dropped. Yes, it's only on paper, but it's not going to help you if you want to refinance further down the track, right? So that's why you've got to be careful. So the most important thing now is that if you're a novice and you're in residential and you're getting minus 1% or 1%, and you're jumping to commercial and you think, wow, 4% is great, 5% is fantastic, you may be overpaying. You may be overpaying because you're not getting the right advice, or you might be overpaying because you're simply thinking that's what other people are buying for. And agents could show me 3 or 4 examples of the latest sales. Well, yeah, because there's other crazy buyers and people who are uneducated out there who are doing exactly the same. And you can't do that, because if you do that, you're doing a disservice to yourself, your portfolio, and for your future wealth creation. Finding your property as a buyer's agent is not about giving you stock. It's not about transaction. What it is about wealth creation. It's about aligning themselves with you and building wealth with you. If your buyer's agent's not doing that, find someone who does. Come and speak to us, come and speak to anybody else. Find someone who aligns themselves, build a strategy for you, and then create wealth. And that's the only way to do it. So that's what happens, okay? So if you have a property, so this is what happens. If you bought a property for 600K, right? The yield goes up to 700. Now your price has come down, might be worth 550. Now, That's fine if the market stays stable. That's fine if the market is going to say, okay, I'm going to stay this way at 7%, 550 is the value of your property, and it's going to stay that way, you know, for the next 12 months. You still can hold the property, you can afford to hold it as the value bounces up. But if the market further drops and your yield starts to go again, might go to 7.5%, then that drops again. So you're dropping to 500K. That's where you get into dangerous territory because you're in negative equity, right? And that's where something you don't want to do. So what happens usually is what we look for in every scenario that we do with a client is that we look at a property. So let's say we look at a property. Let's say you bought this property at 6% yield and $1 million, right? So that's $60,000 in net rent, right? Okay, so if the market goes up by 0.5%, so by half a percent, right? Then your property is no longer worth 1 mil. It's gone up. It's gone up to 1,050,000 or thereabouts, right? This is just rough numbers. But if the yield goes down and say the yield's at 6.5%, like the yield goes down, so it becomes that there's less people buying the market or something happens, now your property's worth 950K, right? But what we look at when we look at a property scenario is what happens if the market goes down, what happens if the market goes up, right? Because in the next 2 years, what I anticipate will happen is the market will go down in yield. So you'll see that 6%, yeah, you'll see the 6% go down to a 5%, right? That's when the market's at its peak. And then what you'll see is the market will correct itself, probably come back to 6.5% for a while, and might level itself up and back to 6%, right? And this period here might be 2 years for that to happen, right? It might be 2 years for that to happen. And the reason that it takes 2 years for it to happen is we got to have the ups, we got to have the downs, and that's what's volatile about up and down in terms of capital growth in a market. And this is what happens in market correction. So if you overpay for a property right now, when the market goes down in terms of yield compression, it's great. You think you've got a great deal because you're sitting, your equity is great and you're getting, you know, you're going to be able to leverage off that property. But when the market corrects itself and the return and the yield goes up, your value goes down, right? Your value goes down. Now you've got a negative territory. And when it bounces back up, you've got to make sure that you are at least at equal to, if not more, than what you originally bought in at. And that's the key to safeguarding yourself. So you've got to look at rental returns, you've got to look at market yield, you've got to look at forecasting, look at catchments, you've got to look at the longevity of the tenant, whether that tenant's going to survive this, because in this period, if the tenant vacates, then you start back at zero, and you don't want that. So you've got to look at all of those scenarios, and we look at all of that when we're doing a deal for a client. And the reason that we do all of that when we're looking at a deal for a client is that it's so important to insulate our clients against the market correction. And we're always checking. We're checking it with a baseline, which when we look at Melbourne and Sydney, we're always checking at that baseline. And then we're looking at other markets, and we're always benchmarking to make sure that the property you get is truly the property that's going to stop and help you in the future, and is really going to accelerate your portfolio, and it's going to protect you against market correction. So be careful with market correction. If you're unsure, you don't know how to take that first step in commercial property, reach out to us, helentarrant.com, jump on a call, and let's work it out. Let's build a plan, let's go forward and create wealth together. So click on the link, Helen Tarrant, don't forget to subscribe, and I'll see you in the next video. Bye for now.